So we're ready to start 7.2 adjustments and the worksheet. And if you're in your textbook, it's on page 548. You're going to also need to look at page 550. There's a completed worksheet there. I don't think I was able to get this on to my screen, so you'll have to be flipping back and forth. So in 7.1, we talked about all the different kinds of adjustments that you'll see. Now in 7.2, we're actually going to go through and I'll show you how to do each and where it goes on the worksheet. So same thing, it might be a little bit overwhelming to start with, just something that you can refer back to and work along with when you're doing these assignments and making sure you're looking at the answer keys that I prepared for you as well. Okay, so here's a list of all of the adjustments that we're going to be putting on A. Rapello's enterprise worksheet. Ending inventory age analysis indicates the balance of 2,000 is required in the allowance for doubtful accounts. Supplies worth 2,000 are left at the end of the year. Depreciation is recorded using the declining balance method. The equipment depreciates 20% and the building depreciates 5% per year. Interest of $225 is owed on the bank loan, and salaries of $1,200 are owed to employees. So those are all of our adjustments. Okay, so adjustments for bad debts. A. Rapello Enterprises uses the balance sheet method to estimate bad debts. The age analysis indicates that $2,000 is required in allowance for doubtful accounts. Since there's already a credit balance, an adjustment of $1,950 is made. Bad debts expense is added to the worksheet and is debited $1,950. A credit of $1,950 is written on line 3, opposite the allowance for doubtful accounts. The debit and credit amounts in the adjustment columns are coded A, and that just keeps those two adjustments together. The adjustments are coded to provide easy identification of the debit and the credit portions for this entry. So you can go and look at the worksheet on page 550 to go through that one. The adjustments for prepaid expenses, as you may recall, prepaid expenses such as prepaid rent, prepaid insurance, and supplies must be adjusted. An inventory of supplies shown of 2,000 total for supplies on hand at the end of the year. The supplies account on the worksheet trial balance section has a 4,500 balance. An adjustment of 2,500 is required. Supplies expense is added to the worksheet and is debited 2,500. The amount of the supplies used, the supplies are on line 5, is a credit of 2,500, and this adjustment is coded B, just to kind of keep that transaction together. Adjustments for depreciation. The declining balance method of depreciating fixed assets is used by A. Rapello Enterprises. The building depreciates at a rate of 5% per year on the declining balance, which is now $111,800. $160,000 minus $48,200 accumulated depreciation equals $111,800. The depreciation expense building is added to the worksheet and debited $5,590. You took 5% of what the building was worth. Accumulated depreciation is credited $5,590 and the adjustment is coded C. Equipment depreciates at a rate of 20% per year. The declining balance of the equipment account is $12,800. It was $23,000 minus the $10,200, which is in the accumulated depreciation. We need to add the depreciation expense equipment to the worksheet, and we need to debit it $2,560, which is 20% of what it's now worth. Accumulated depreciation equipment is credited $2,560 on line 9, and we code that adjustment as D. Okay, we also have adjustment for accrued interest. 3 months interest is owed on the bank loan. The total interest amount to $225. That's found by taking 10,000 times by the 9%, and you're paying for 3 months out of the 12 gives you $225. Both interest expense and interest payable are added to the worksheet, and the $225 adjustment is coded an E. Adjustment for accrued salaries. The salaries adjustment is made to record the $1,200 owed to the employees. Salaries is debited $1,200. Salaries payable is added to the worksheet and is credited $1,200. the adjustment is coded F. So those ones I've talked about, you can clearly see those in the adjustments column on the worksheet on page 550. Adjustment for merchandise inventory, and this one is using the perpetual inventory system. This is one that you might have to kind of go back and look over a little bit. Under the perpetual inventory system discussed in Chapter 7, the merchandise inventory account is continually adjusted as merchandise is bought and sold during the accounting period. What entry may be required to ensure the accuracy of the inventory account at the end of the accounting period? As you learned in Chapter 7, an entry may be required to record the difference between the physical inventory taken at the end of the fiscal period and the merchandise inventory ledger account. The calculation to determine the inventory position on December 31st is as follows. Merchandising inventory, 76,000. The physical inventory, when you took the actual count, was 75,450. So the inventory that you were short was 550. The journal entry to record the inventory shortage looks like this. Inventory shortage debit of 550, and your merchandise inventory has to come down by 550. Inventory shortage is an expense account and is shown on the income statement. The entries required to adjust inventory for a firm like A. Rapello Enterprises, which uses a periodic inventory system, are somewhat different. Okay, so now here's the periodic inventory system. The worksheet in figure 11.6, if you look on page 550, contains the merchandising inventory account with a January balance of 90,000. This means that at the beginning of the fiscal period, the goods on hand were 90,000. During the year, merchandise was sold and the sales transactions were recorded in the sales account. Merchandise was purchased when it was required and recorded in the purchases account. At the end of the year, merchandise inventory must be adjusted since it contains the cost of the merchandise on hand at the beginning of January 1st. This figure is incorrect. It has changed because of sales and purchases of merchandise during the year. Merchandise inventory must be adjusted so it contains the value of the inventory on hand and at the end of the year. This value is obtained by taking a physical inventory at the end of the fiscal year. This adjustment will now be examined in greater detail. In line with the periodic inventory method, entries were not made in A. Rapello Enterprises merchandising inventory account during the accounting period. At the end of the accounting period, an adjustment is needed to update and balance of the merchandise inventory. So steps in doing so. Step number 1, determine the value of the ending merchandise. At the end of the fiscal period, a physical count called taking an inventory is made of merchandise on hand. This results in a dollar amount of 86,000 for the merchandise inventory account. This is the actual value of the merchandise on hand. The next thing you need to do is prepare a closing entry for the merchandising inventory. An entry is made to remove that beginning inventory figure. This is necessary because the beginning merchandise value has been replaced by the 86,000. This entry is made to close, this is important, the beginning inventory. So you are closing the inventory with a credit of 90,000, and when you close it, you have to transfer it somewhere, and for now, you're going to transfer it to the income summary account. And we use the income summary in grade 10. Now you have to prepare the entry to record the value of the inventory. So now we know our inventory is now at 86,000 and we need to transfer that amount to the income summary. This entry is necessary because the inventory on hand at the end of the year is an asset and must be recorded. The merchandise inventory account now appears as follows. So you had 90,000, you closed it, now you have the right amount, 86,000. And in the income summary, when you closed it, you had the 90,000, and now you have 86,000 in it. The beginning inventory of 90,000 is on the left, or on the expenses and cost side of the income summary account. The new inventory figure of 86,000 is on the revenue side. Recording the inventory adjustment on the worksheet. The two entries that have just been described explain how merchandise inventory is adjusted at the end of the accounting period. This adjustment can be organized on a worksheet before the journal entries are made. And if you look here, it'll show you. There's 3 steps. Transfer the beginning inventory value of $90,000 to the debit column of the income statement section. This $90,000 figure is required as part of the calculation for the cost of merchandise. And if you look, it's right there. Record the new inventory value, $86,000, in the credit column of the income statement. And if you look at figure 11.8, it'll show it to you there. This is the other part of the calculation required for the cost of merchandise sold. Record the new inventory value, $86,000, in the debit column of the balance sheet, because now that's what our asset is and it has to go into the balance sheet. And if you look at figure 11.9, you can see it there. Trace the 3 steps described above through figure 11.7, 11.8, 11.9, rather than preparing separate entries to adjust merchandising inventory. The count is adjusted as part of the closing entry procedure discussed in the next unit. And you can look at page 554 where those figures are. And when you want to complete the worksheet, if you look at page 550, you will notice that you have, I'm just going to actually look at that right now too so I can refer to it. Make sure that you have single underlines to show that you are adding. You have double underlines when things are balancing. On the left side at the bottom, you need to have the word net income. And notice that the net income is the same on the income statement portion as it is on the balance sheet. And single underline and double underline at the very end. That is how you complete your worksheet. Now there's another way of adjusting merchandising inventory that I'll just take a minute to go through. The method of adjusting merchandise inventory that you just learned for A. Rapallo Enterprises is commonly used. However, other methods are just as acceptable. The following method treats the entries for beginning and ending inventories as adjusting entries on the worksheet rather than preparing them as closing entries. So that's kind of the main thing there. The one I'm going to show you now is doing this with an adjusting entry instead of as a closing entry. The same data from A. Rapallo Enterprises will be used to illustrate this method. The worksheet in figure 11.10 has been completed using the merchandising adjustment method. So if you want to have a look at that page, you can. Can you identify the changes in the worksheet? These are adjusting entries G and H on the worksheet. What effect do these entries have on the merchandising inventory and the income summary accounts? So if you look at page 556, it would look like this now. Your adjusting entries would be closing or putting a credit of $90,000, transferring it to the income summary. And now your merchandising inventory and your income summary as well. But you notice that those are only in the adjusting columns now, they're not anywhere else. And this is what your general ledger accounts would look like. So now you have those both methods, and whatever the textbook wants you to do, you have something to go back to refer to.